Hi, this is Seema Arora, and this is a podcast on sustainability, climate, business, economy, and tech. Happy New Year! It's January, and I'm sure a lot of people have made resolutions to read more in the new year because reading is learning. I know I have made that resolution. And to give a jump start to my and your reading goals, I'm reviewing a book called 1929. It is written by Andrew Ross Sorkin. And for those of you who don't know him, Andrew Ross Sorkin is a financial columnist for the New York Times, co-anchor of the Squawk Box on CNBC, and the founder and editor of Deal Book. So 1929 by Andrew Ross Sorkin is a must-read for anyone interested in financial markets, economic theory, and the recurring patterns of financial crises. It is a tour de force on the Great Depression, the most severe economic collapse in U.S. history, and the book offers a penetrating examination of the complex nexus between Wall Street, high finance, and politics. Though the book spans roughly 450 pages and may feel intimidating, it is deeply rewarding and offers enduring lessons on markets, economics, speculation, politics, regulation, and in general human behavior. So, let me lay out the book's narrative structure and scope. The book traces a chronological build-up of events, reconstructing the path to the market crash month by month until the final day in October 1929. Crucially, the story does not end with the crash. Sorkin devotes nearly 100 pages to the aftermath, documenting the economic devastation, the political reckoning, the birth of sweeping financial regulations, and the gradual build-up towards trials and accountability. The prose is vivid and very character-driven, reading almost like a screenplay, making the story feel cinematic in both scope and pacing. This chronological build-up successfully builds up the cinematic vision. I expect Andrew Ross Sorkin to be talking to Hollywood producers in 2026. However, this chronological build-up, from the standpoint of it being a book, I feel the book can be a little difficult to navigate as it does not prepare the average reader who might be just interested in learning about the crash and who might not be very well versed with the economic issues and themes that are critical in the book. And so I will try to lay out some of the themes only in the hopes that the material becomes easier to navigate and provides a background to the reader. So just to start with, there are some central characters in the book. At the center of the narrative is Charles Mitchell, also known as Charles Sunshine Mitchell, the powerful CEO of National City Bank, the precursor to Citibank. Mitchell emerges as a symbol of the era's excesses, an unshakable optimist, and he's surrounded by an equally formidable cast. This includes Jack Morgan, son of J.P. Morgan, Thomas Lamont, senior partner at the House of Morgan, and the intellectual and diplomatic face of Morgan. Also included are the brothers Richard and George Whitney. George Whitney was the partner at the House of Morgan, and we find that Richard Whitney, who later became the New York Stock Exchange head and who was instrumental and was called as the White Knight of Black Thursday when this happened, also was involved later in wrongdoing. The cast of characters also includes people like Winston Churchill, and basically there are many celebrities that were involved in this financial schemes, either in trying to get themselves enriched. The narrative spans the presidencies of Herbert Hoover and Franklin D. Roosevelt, capturing a defining transition in American political leadership during economic collapse. So the first theme that the book addresses is of credit, speculation, and the optimism illusion. The book documents the rise of credit in the economy in the 90s, the rise of buy now, pay later schemes, which already was becoming very popular, but that it found its way into the stock market. So the idea of buying stocks on the margin became popularized. And what does that mean? It meant that there was a way for individuals to open margin accounts. And this meant that individuals could buy these with very little upfront money, and they could borrow money to then buy the stocks that they so desired. This encouraged huge amounts of leverage. In fact, the stocks that they bought by leverage could in turn be used as a collateral to buy more stocks. This resulted in indiscriminate amounts of borrowing and indiscriminate amounts of leverage. And the illusion that was being sold was that the stock market is only going to go up. So it also encouraged a strange kind of risk taking behavior and speculation. So this fueled what Sorkin presents as an optimist illusion, the belief that markets could only go up. Investment trusts proliferated, marketed as vehicles that promised effortless wealth accumulation. National City Bank, under Charlie Mitchell and House of Morgan, played key roles in promoting these instruments, expanding market participation and obscuring risk. Stock ownership increasingly became a mechanism for the wealthy to grow even wealthier, while drawing them also into fragile, debt-fueled financial structures. The theme, too, that emerges in this book is the rise of global politics and finance. Sorkin situates the crash within a broader geopolitical framework. This is a time when Germany was refusing or was not able to afford the reparations that it had promised. The political appointees of the US had failed to get any promises of payments, and so they recruited these men of influence, basically from finance, with the likes of Thomas Lamont, to broker these deals. The House of Morgan sent Thomas Lamont on a mission to arrange the German reparations. And so high finance and politics were deeply intertwined, giving the financiers an outsized role of influence, not just in the US, but internationally. Political power figures like Churchill and Lamont operated at the intersection of diplomacy and capital, often trading favors for each other. These international figures wanted an in into the US stock market as well. With the role of American financiers in structuring and executing international reparation agreements, it was clear that there was going to be always this tension, as well as the fact that high finance and geopolitics were no longer inseparable. They operated through the same elite networks of power and influence. A third theme that is prevalent in the book that has been created by Sorkin is this close song and dance between the Federal Reserve and the banking community. Now, this tension illustrates the early struggle of the Federal Reserve, which was created after the Panic of 1907 to assert authority over powerful financial institutions. Now, just a word about that. Charles Mitchell, the protagonist, so to say, of our story, was recruited by then Chairman of the Federal Reserve, Benjamin Strong, to be on the board of governors. And he recruited Charlie Mitchell simply because Charlie Mitchell was critical of the role of the Federal Reserve. And Benjamin Strong thought it would be a good idea to have somebody who is so critical on the inside of the Federal Reserve. Interestingly enough, when the crisis started to unravel, it created an immediate conflict of interest. Charlie Mitchell was always advocating for interest rate cuts to fuel the speculative mania that he was part of, or at least not let it go bust, since he wanted money in the end even to buy up his own stocks of National City Bank to prevent them from going into a free fall. So the idea that the banking community wanted the Federal Reserve to provide cheap credit to sustain the speculative activity, the Fed, by contrast, attempted to curtail speculation and apply brakes to the frenzy, fearing a systemic collapse. Bankers, led by figures like Mitchell, demanded cheap credit to sustain speculation. So this conflict foreshadows modern debates about the central bank independence, asset bubbles, and the moral hazard. And here of note is the fact that many attribute the cause of the crash to Federal Reserve's actions earlier on, whereby it increased interest rates in 1928 as well as in 1929. And some believe that it caused the crisis to be worse. The fourth theme that is handled in the book and is developed is this whole um, the difference in leadership styles of Hoover versus Roosevelt. The contrast between Herbert Hoover and Franklin D. Roosevelt is one of the book's most revealing lenses. Hoover hesitated to fully acknowledge the severity of the crisis until Black Tuesday, when the market plunged 11.4% in a single day. The decline accelerated, and with markets reaching new lows, cumulatively it was down almost 23%. But Herbert Hoover was kind of nonchalant and did not want to even address this massive decline in stock market activity, even though it was staring in the face. During this time, Andrew Mellon, the Treasury Secretary, again was not too bothered by this speculative frenzy that was now going completely bust, and he had no sympathy for the speculators. He argued that excesses should be allowed to liquidate naturally and believed in a very laissez-faire approach to the downward spiral. On the other hand, from the financial community as well as from William Randolph Hearst, Thomas Lamont, first of all, wrote to President Hoover and said that maybe there should be a statement that allays the concerns from the people in general so that there is no run on the banks. Remember that this speculative frenzy was being fueled by excessive leverage from the investment side, and all it meant was that people's deposits, like safe deposits, were being used for going into very leveraged and speculative activity. And so what if there might be bank runs? And Lamont was very aware of that possibility and wanted Herbert Hoover to address this and say that there is confidence in the economy and nothing like that would happen. So it required a lot of cajoling by these financiers to bring that to Hoover's attention. By some accounts, and the book lays this out, Hoover's framing of the problem was, he kind of said, this is not a panic, it's actually a depression, and that framing stuck through for a long time. But anyway, on the other hand, as the downturn deepened, a political blame game started to emerge, and was responsibility shared by a Democrat-controlled Congress, the Treasury, or the financial elite who had fueled the speculative boom? And Carter Glass, the Virginia Democrat, who was co-architect of the Federal Reserve Act, ultimately found a focal point for accountability in Charles Mitchell, whose behavior came to symbolize the failures of unchecked finance and regulatory absence. Even though there were many who were to blame for this entire um failure of the market. Then there was the election of Franklin Roosevelt, and that marked a decisive shift. He won by landslide victory, even though Hoover supporters believed that the handling of the economy wasn't Hoover's biggest problem. Nevertheless, when Roosevelt, who was a Democrat, when he came into power, he advanced an aggressive regulatory agenda and fundamentally reshaping the financial system and redefining the federal government's role in markets. Lastly, I'm going to touch on, and again, try to be as quick as possible, the theme 5 that is addressed in the book is about regulation, reform, and accountability. The aftermath of the crash produced sweeping reforms aimed at addressing market opacity and debt-fueled speculation. Interestingly enough, the idea of self-regulation came in. And on March 7, 1933, a National City Company agreed to separate from National City Bank. That is, the securities arm of the bank separated from the banking arm. And this this action was unilateral, and it was in the face of a regulation that Carter Glass was working on, whereby there would have to be separation, and which became later the Glass-Steagall Act, separating commercial banking from investment banking, reducing conflicts of interest and excessive risk-taking by the investment arm of the bank. But that this was preempted by a national city. And interestingly enough, this was the language of the act, the Glass-Steagall Act, was written and presented to Roosevelt. The language was written by another banking stalwart of Chase, His name was Winthrop Aldrich. He wanted to make sure. So the initial Glass Act was that this separation should only happen for publicly traded banks. And the House of Morgan was going to be okay because it was a private bank. But Winston Aldrich from Chase wanted to make sure that House of Morgan also suffered the consequences, and therefore he wrote the language whereby all banks would be required to separate these functions, and also, more importantly, also that they could not hold directorships between the two arms, which was something which was commonplace for House of Morgan. So, long story short, Winston Aldrich also wrote in requirements for smaller banks to have Federal Deposit Insurance, and this was again appealing to Roosevelt, even though it was not in the initial regulations that was being proposed by Mr. Glass. In any case, so one of the outcomes was again the passing of the Glass-Steagall Act, also known as the Banking Act of 1933. Second kind of outcome of the regulatory aspect of it was the creation of the Securities and Exchange Commission. And this was in 1934, it was created to enhance disclosure requirements and reduce market opacity. And all these regulations basically were to correct what went wrong in 1929 and establish transparency to markets and protect investors. So those are the kind of broad themes that are touched in the book. Why does this matter today? As we all know that these crises have a tendency to recur. Sorkin, as he concludes the book, of course, there's this trial of Charlie Mitchell happening, and he was exonerated. Throughout, I think the main kind of takeaway is that, and Sorkin is comfortable with that, is that could this have been prevented or not? Who is to blame? Well, the blame is for many to take, but there's no real one person or entity, so that it's more the system that fails to work at the time. His introduction, he has a quote from Albert Einstein, which reads the following, and I'm reading from the book, and this is Einstein's quote in October 26, 1929. The ordinary human being does not live long enough to draw any substantial benefit from his own experience, and no one, it seems, can benefit by the experience of others. Being both a father and a teacher, I know we can teach our children nothing. Each must learn its lesson anew. And again, simplifying that, and in the context of the crash, every crash will be different and it will happen again. But in the light of today's events, we all know that with AI being the new kind of driver for this speculative mania, there is applicability here. The delicate role of the Federal Reserve is reminiscent of what happened in this crisis and the crises that have happened since. And so it is important to know a little bit more to prevent maybe some recurrences, but also to be informed about what has happened before. And I think an important idea today, and of course, is this whole notion of can regulations deter further crashes. And the Glass-Steagall Act already was repealed in 1999 by President Clinton, and right now we know that regulations are gradually being done away with, including at the SEC. And the idea is always, does the regulation stifle innovation or does it prevent recurrences like this? And right now, under President Trump, clearly we are doing away with regulations. And again, it's always a delicate balance. And there's so much to think about here, and you could go on any tangent. But it's a great read, and I hope this helps in placing some of the arguments in context as you pick up the book and read for yourself. With that in mind, this is all I have to say for now. This is Seema Arora signing off, and happy reading.